Hi everyone, so today we are going to be talking about credits and deductions, and this will be the final video in the main series of the conceptual videos related to this year's VITA training. And so just to go over real quick what is going to be covered in these slides, we're going to talk about adjustments to income, what the standard deduction is, we're going to talk about itemized deductions as well, and we're going to talk about specific tax credits that are going to be relevant for this year. And so, just as a frame of reference here to get started off with this lecture, I think it's instructive to think about where we are sort of in this chart here. And so, for those of you that don't recognize this already or haven't taken Professor Krull's class where you will see this over and over again, it's important to understand what the general flow of a tax return is to eventually get out to the calculation of the amount of tax due or the amount of refund that they have due. And so as we look here at the top, we start with what the gross income of the taxpayer is, and then we subtract out adjustments to the gross income, and that gives us the AGI. And so really up here in this top section is what we have been talking about in our lectures so far to a large extent. And now we are going to move down into the standard deduction or itemized deductions and the credits and prepayments that the taxpayer has had. And using those, we're able to plug those in, and eventually it will spit out our tax due and refund. So as a frame of reference, just understand that we're primarily going to be working today in these sections down here as we move away from focusing on income and focusing more on deductions and credits. And so the first section that we're going to talk about is adjustments to income. So the question that you probably have is, what is an adjustment to income? Because that is not very specific, and unfortunately the definition that we are given from the IRS is also not super specific as well. Basically what an adjustment to income is that taxpayers are allowed to subtract certain expenses from their income, which we can see on this slide here if we go back one. And so really the way to think about adjustment to income mostly is that it's very similar to a deduction, but it's just different in where it is applied here in the steps when we're eventually calculating the tax due or refund there at the end. It just gets taken out earlier. And so what are some common clues that a taxpayer may have adjustments to income? And so some of the common clues that you can look for when you're preparing a return are: did they pay qualified educator expenses? Did they receive income from self-employment? Did they have self-employed health insurance? Did they pay a penalty for early withdrawal of savings? Did they pay alimony? Did they make contributions to a traditional IRA? Did they make contributions to a health savings account? Did they pay student loan interest? Did they receive income from jury duty that was turned over to an employer? Or did they have a Form W-2 Box 12 Code H contribution to Section 501c 18D pension plan? And so that checklist is available for you, and it's something that I would keep in mind when you start a return, because if it's on that list, a expense that they have, then there is a good chance that you're going to have adjustments to income. And so now we're going to start talking about some of these in more detail. And so the first one comes up, and one of the most common ones that I would say that we see at our site is educator expenses. And so eligible educators can deduct up to $250 in qualified education expenses. If both spouses are eligible educators, they can deduct up to $500. But an important note here for you to consider is that they each can only deduct $250 max. So if two spouses were eligible educators, then each of them could deduct $250 and add that together for $500, not necessarily $300 for one, $200 for the other, add to $500. That is not how that would work. And so getting into more detail here about who is an eligible educator, because there actually are specifics on who is allowed to list themselves as an eligible educator for this credit. And so some of the main traits of those who we see most often qualify for this credit are they are a teacher, instructor, counselor, or aide in a school, and they primarily work with grades K through 12. And so what this means is that this credit does not apply to someone like a college professor or a college instructor or aide, because they do not primarily work with grades K through 12. Additionally, they have to be employed at least 900 hours during the school year. For most taxpayers who come in and try to claim this credit, we do not often see this be an issue, but it's still something that you need to ask the taxpayer and verify that they were in fact employed for at least 900 hours during the current school year. And so you're probably wondering why I threw out that term education expenses. What exactly qualifies? Because as we know from the last lecture, the IRS has specific criteria for what expenses they allow to qualify for education. And so the main expenses that we see qualify for educator expenses are items such as books, supplies, equipment, materials used in the classroom. That one's a little more vague there, and it can depend on the discipline that the educator teaches, and that's something that's important to reference in publication 4012. Additionally, they've updated this so that COVID-related expenses are also able to qualify, and professional development related to curriculum and instruction also qualifies as educator expenses that can be used toward that $250 adjustment to income. So those are the main ones that you are looking for there, and you're looking for those for a qualified educator who meets the standards that we talked about. And so the next major credit or adjustment to income that we are going to talk about is the self-employment tax. And so self-employed taxpayers can deduct a portion of their self-employment tax. And so this is one of those adjustments, and we're going to see more of this with the deductions and credits that are important to know conceptually, but you actually do not have to do the calculation or much work for yourself really, because this is calculated in TaxSlayer. So all you really need to know is that it exists and to make sure that it gets included if they in fact did have self-employment tax paid. So again, understand conceptually that they can deduct a portion of their self-employment tax, but you don't have to know how to calculate yourself because TaxSlayer will do the work for you. And so moving along here in the self-employed theme with regard to adjustments to income, self-employed taxpayers who report a net profit, it's important to note that they report a net profit, not a net loss, on Schedule C may be able to deduct the cost of their health insurance. So the insurance plan must be established under their trade or business, which makes sense because if you're going to deduct something as a sort of business expense here, which is really kind of how they're structuring this, being that it's for self-employed individuals, it makes sense that it has to be established underneath that trade or business. And then the deduction cannot be more than their earned income for the trade or business, which again, that makes sense so that you can't use your health insurance as a way to basically not pay any tax on your self-employed income. And then lastly, the deduction is limited to the net self-employment profit shown on the return reduced by the deduction for 1/2 of the self-employment tax. And so again, that's a bit of a mouthful to get through, and that can be a bit of a complicated limit there. And basically, this will come up over and over again. I should probably touch on what a limit actually is. Basically, for a lot of these credits and deductions, there's a max amount that they can deduct or take a credit for. And so really that's what the limit means, is the limit is the maximum amount that they can deduct in this case, or claim as a credit, as we'll see later on in this lecture. So here, for self-employed health insurance, we see that the deduction is limited to the net self-employment profit shown on the return, reduced by the deduction for 1/2 of the self-employment tax. And so this is another one of those items where it's important to know that it exists conceptually, but be sure to use your materials and let TaxSlayer do some work for you with regard to the self-employed health insurance deduction, and it's not one that we run into a ton. So another one here is the penalties on early withdrawal of savings. And so taxpayers can adjust their gross income to deduct penalties paid for withdrawing funds from a deferred interest account before maturity. And so this is an important one to look out for, and again, one that you need to know conceptually and understand how to enter it into TaxSlayer, but won't involve any super complex computations for you. And so moving on for alimony for pre-2019 divorces, as we talked about in the income lecture already, alimony payments can be deducted as an adjustment to income if the divorce was executed prior to 2019. And so if the divorce was executed in 2018, 2017, 2016, and so on, going all the way back, then they can deduct the alimony that they pay as an adjustment to income. But again, it's really important, as we talked about in the income section, to pay attention to when that divorce was executed, because that determines in this case whether or not the alimony payments can be deducted by the individual paying those payments. So again, one that's not too difficult to calculate, it's just really important to understand conceptually. In the next one that we'll talk about are IRA contributions. So we've talked about IRAs already, and I think it's a theme that you should start to see here between the income and the deductions and credits and adjustments, is that many of them go hand in hand, and you should start to see some patterns emerge and some common types of accounts, such as IRAs, that are going to be particularly important when filling out a return. And so with regard to IRAs, taxpayers may be able to deduct some or all of their IRA contributions, but it's also important to note that contributions to a Roth IRA cannot be deducted, but the taxpayer may be eligible for the retirement savings credit. And for instructions on specifically what IRA contributions are going to be deductible as adjustments to income, you can reference publication 4012 and the instructions in there. Those will give you the instructions that you need. But it's important to understand that if you see that a taxpayer has contributed to an IRA, that you are going to have to do some digging within publication 4012 to check and see if they in fact can deduct them as adjustments to income. And so getting into a little bit more detail on those, so there are some key eligibility requirements for an IRA contribution. So the first one is the type. Only contributions to a traditional IRA are deductible. So if you'll remember, we talked about a bunch of different IRAs in the last lecture. All of those besides the traditional are not going to be deductible. So with regard to compensation, which is the next requirement, individuals must have taxable compensation. So if you're making contributions to an IRA, but you don't actually have any taxable compensation, you cannot deduct it. And then lastly, time limits. The contributions must be made timely within filing the return. And so that's another important one to look at there, and there's more specifics on that within publication 4012 as well, but those are the three main criteria that we see with regard to whether or not an IRA contribution can in fact be deducted as an adjustment to income. And so probably the next question you have is, how much of an IRA contribution can in fact be deducted? And so generally, the rule is that you can deduct the lesser of the contributions to your traditional IRA for the year, or the general limit reduced for Roth IRA contributions made. And specifically, there are special rules for spouses, so consult resources for this info, and it may be phased out due to income and other factors, so I cannot emphasize enough. You really should for every deduction, credit, or adjustment that you are entering. But specifically when we talk about IRA contributions, it's really important that you leverage publication 4012 and ask for help if you are unsure of how to determine whether or not a contribution can in fact be deducted, because there's a lot of intricacies to it, and it's really important that you use those resources because they'll give you the tools that you need, and you should really not try to memorize this because there is a lot of info in here to know, and that would not be practical or the best for you, because those resources will give you all the answers that you need. And so the next topic that we are going to talk about is health savings accounts. And so this is something that I know that I didn't really know anything about until I started volunteering with VITA, but they're actually not super complex conceptually. And so what a health savings account is it's a type of savings account that lets you set aside money on a pre-tax basis, which we talked about what that means in the last lecture that we did, for qualified medical expenses. So basically what it is it is an account that lets you pile up money on a pre-tax basis that you're going to pay for qualified medical expenses with. And generally, distributions from an HSA are not taxable as long as they are used for qualified medical expenses. And this is another one of those adjustments where the deduction amount is going to be calculated for you by TaxSlayer. So you don't need to worry about any of the craziness with that. but you just need to be aware that if they have a health savings account, then they may be able to deduct some of it. And so student loan interest. And so this is going to be one of the items that I'm going to get into more detail on, because to be honest, this is going to be one of the ones that we see most commonly, which should not be a surprise considering that we are on a college campus. And so the student loan interest deduction is generally the smaller of $2,500 or the interest paid on a qualified student loan. And another important note here is that the deduction amount is phased out with income and filing status, much in the way we talked about earlier for other adjustments to income. So it's really important to reference publication 4012 and make sure that you're always using your resources to ensure that you are calculating the correct amounts when you have to. And another criteria here, which you're probably seeing a theme here with regard to education, is that the student loan must be used on qualified education expenses, and it should come as no surprise that the IRS has a specific definition of what qualified education expenses are. So again, just to get across the big picture point again, student loan interest, if you paid student loan interest, there's going to be a deduction for that, and it's important to be aware of that. And again, use publication 4012 to figure out the exact amount and make sure that the income and filing status are correct with regard to the amount that it generates as being phased out. And so what type of student loan interest qualifies for this specific tax benefit? And so the loan must meet all of the following conditions. It was for the taxpayer's spouse, or a person who was the taxpayer's dependent when the loan was obtained. So where it talks about the dependent there, really that's talking about when a parent is going to most likely try to claim a student loan interest deduction for themselves. And additionally, as the second condition here, the qualified educational expenses were paid within a reasonable amount of time before or after obtaining the loan. So basically, all this is saying is that you can't obtain the student loan for example, you paid education expenses a couple years ago and then you get a student loan and try to deduct it as being a student loan. That obviously is not a reasonable amount of time. And so this is an area where we have to exercise a little bit of professional judgment. And third, it was for an eligible student, and you can find a specific definition of this in publication 4012. But really, the way that you can primarily think about this is, were they a full-time student? And so what are some specific exceptions here? So the IRS has a few exceptions that are important to note with regard to the student loan interest deduction. And so an individual can be your dependent even if you are the dependent of another taxpayer. An individual can be your dependent even if the individual files a joint return with a spouse. And an individual can be your dependent even if the individual had gross income for the year that was equal to or more than the threshold amount for the year. So these exceptions are important to understand, but I would really focus on these two slides. And again, refer back to publication 4012 where you can check for exceptions, but you do not have to memorize these. These are going to be some of your primary slides to focus on when you think about student loan interest. And so, who specifically is eligible for this deduction? Generally, a taxpayer can claim this deduction if the following are true. They are not filing married filing separately, so this is another reason why we discourage most people to file under that filing status. They will not be claimed as a dependent on someone else's return. The taxpayer is legally obligated to pay the interest, and the taxpayer actually paid the interest. So those last two are important there because the person who's legally obligated to pay the interest is the one who is able to claim the deduction, and the person who actually paid the interest. This is something that students will sometimes not understand. For example, if their parents are the ones actually paying the loan and legally obligated to pay it. And so, we talked about earlier, the IRS has some specific higher education expenses that they deem as being qualified for student loans to be used on. And so tuition and fees, room and board, books, supplies, equipment, and other necessary expenses, that right there is supposed to say such as transportation. Should be pretty clear that such as expenses would qualify, but there you go, my trademark typo that you're going to find at least one of in every slide. I will be sure to update that. But the important thing to note here with regard to qualified education expenses is that room and board is actually allowed to be a qualified education expense for student loan interest. And so that is different than what we learned about in our last lecture when we talked about whether scholarships are actually going to be taxable or not. So that's an important thing to note there. Room and board is a qualified education expense when we're talking about the student loan interest deduction. So the next topic that we are going to talk about as we move on from adjustments to income is the standard deduction. And this is a very important concept to understand because basically all of our clients will choose to take the standard deduction instead of itemizing their deductions. And really what the standard deduction is it is a set deduction based on filing status that is available to all taxpayers. And it is increased for taxpayers that are over the age of 64 or that are blind. And the standard deduction amount is lower for those who can be claimed as dependents, and we're not going to talk about what the deduction amounts are for dependents in this lecture, but you can find them in publication 4012. And so really what you need to remember about the standard deduction is that it is a predetermined deduction based on an individual's filing status and a few other life factors that is available to all taxpayers to take rather than itemizing their deductions, which we are going to talk about later. And so this chart here shows what the standard deduction amounts are for this year, and you can find this in publication 4012 as well. And you should see here that these standard deduction numbers here are very similar to the requirements to actually file a tax return that we talked about way back in one of our earlier lectures, and that is not a coincidence, in fact, because the standard deduction is one of the main thresholds for determining whether or not an individual is legally required to file a return, because this is a deduction that all taxpayers are entitled to, and the amount of that deduction is based on their filing status here and some other life factors which we talked about a little bit on the last slide, and there are other resources in publication 4012 if any of those life factors apply. But again, standard deduction, it's a predetermined deduction available to all taxpayers that they can choose to take if they do not want to itemize all of their deductions, and the vast majority of our clients are going to take the standard deduction. I don't in fact think I've ever prepared or even reviewed a return that itemized their deductions, so it is extraordinarily rare that they do not take the standard deduction. And so another deduction that we need to talk about as well that often gets lumped in to the same section here, if we think back to the chart that we talked about at the beginning of this lecture, is the deduction for qualified business income. So really, this applies mostly to sole proprietors. So those are individuals who own a sole proprietorship, and they can take a deduction of 20% of qualified business income. And importantly here, taxable income cannot be reduced below zero by this deduction. And so it can only reduce their income to zero. It cannot reduce it below zero, which in tax terms means that it is a non-refundable deduction here. So we can't take their income below zero with it. And additionally, the deduction is limited for higher incomes. And this is one that we very rarely see. And so I'm not going to spend a ton of time on it in this lecture here. But if you do see qualified business income that an individual has, or that they own a sole proprietorship that they actually have income for, refer to publication 4012 for info, because this topic can get more complicated very quickly, and it will be important to use that resource when you're preparing that return. But again, just be aware that if they have business income from a sole proprietorship, this is likely something that they can take advantage of. And so moving on from standard deductions, now we're going to talk about what itemized deductions are. And so really what it is it is the alternative to taking the standard deductions. And so with itemized deductions, basically what happens is the taxpayer goes through one by one and says, this is the amount I can deduct for this expense, this is the amount I can deduct for this expense, and they add them all up to come to a total amount for their itemized deductions. And taxpayers should only itemize if it provides a higher refund for them than the standard deduction would, unless they are legally required to itemize their deductions. And so who is required legally to itemize? Well, there are a few scenarios where you are legally required to itemize that you can find in Publication 4012, but the most common one that we see is that the taxpayer is married and they are filing a separate return and their spouse chooses to itemize. So if a married individual has a spouse that is itemizing, they also must itemize their deductions, which is again another reason why we in general discourage people from married filing separately filing status, because most often itemizing is not going to help the taxpayers that we serve, and so this can potentially be very detrimental to them. And so how can an individual decide whether or not to itemize, and how can you as a volunteer help them decide whether or not they should itemize? And so the most common reason to itemize would be large unreimbursed expenses, such as medical and dental expenses, which we are going to talk about. So again, be on the lookout. If they had a ton of unreimbursed medical and dental expenses, those can add up quickly, as we all know. And so that is a case where itemizing may make sense, but in most cases, itemizing will not make sense. And a tip here is if you enter itemized deductions into TaxSlayer, it will choose between the standard deduction and itemized deductions for you. And so that's something that I would recommend that you just get in the habit of, even if it makes a return go a little bit longer, is that if you just enter the itemized deductions in, you're good and TaxSlayer will do the math for you. So that's an easy little tip there that can take some of the stress off. And so medical and dental expenses, which we just talked about, taxpayers can deduct unreimbursed medical and dental expenses that exceed 7.5% of their adjusted gross income. So it's again where it's important to think back to that chart there. But again, TaxSlayer will help you out here, and Publication 4012 is also going to help you as well. And with regard to medical and dental expenses, again, this is a topic that can get complicated very quickly. And so I would refer back to the resources Publication 4012 for what specific expenses count, because the list is very long and this slide would get a little unruly and very tedious if I were to walk through all of them one by one. But no, you can find a list of what expenses count, and that will help make your life a lot easier. You do not have to play the guesswork game with this. And so another itemized deduction that you can sometimes see is that taxes can be deductible in certain cases. And so the three kinds of taxes that we often see that can be deductible are state and local income taxes, sales taxes, and real estate taxes. So an important note here is that they may deduct either sales taxes or state and local income taxes, but not both of them. And this specific deduction is limited to $10,000. And we talked a little bit about what limits were previously, but again, as a refresher, a limit is basically the maximum amount of a deduction or credit. And so the deduction is limited to $10,000 in this case, and $5,000 if married filing separately. Again, you should see the benefit is lower for married filing separately, and so you should be seeing a pattern of why I so strongly discourage that filing status in most every case. So again, if you see taxes were paid and the individual is choosing to itemize, they may be able to deduct a portion of those taxes. And so interest paid, and so there are different kinds of interest that can in fact be deducted, but the most common one that you will see is home mortgage interest. And again, I would refer back to publication 4012 on this because it is a less common topic just due to the fact that it is an itemized deduction, and in general, we're not going to see a lot of other forms of interest besides home mortgage interest. And so, gifts to charity. So, a donation or gift may be deductible if it is given to a qualified organization. And a cool thing about this is that while you can deduct more if you itemize, taxpayers who do not itemize can deduct up to $300 of cash contributions to a qualified charitable organization. And so while this is in the section for itemized deductions, that $300 deduction of cash contributions also applies to taxpayers who do not, in fact, itemize. And I would again cite to refer back to resources to ensure that the gift can be deducted, because there are multiple criteria that the gift has to meet in order for it to be tax deductible. And if an individual has charitable contributions of greater than 20% of their AGI, they should be referred to a professional preparer, and we cannot prepare that return. And so, again, if you see an individual that has a large amount of charitable gifts, if it's more than 20% of their AGI, they should be referred to a professional preparer. And so, a smaller topic that we occasionally see, but they love to test for on the exam, are gambling losses. So, gambling losses can be deducted to the extent of their winnings. And so, basically what that means is that you can't use gambling losses to reduce your taxable income by more than you actually made in profit. So if you go, you gamble, you lose $1,000, you make no money, you can't deduct any of that. But if you go, you lose $1,000, but you win $500, you can deduct $500. So that's the important thing to remember here with gambling losses. They can be deducted to the extent of their winnings, but they cannot deduct more than that. And that's to avoid, again, people just claiming massive amounts of deductions for losing a lot of money gambling. But you can, in fact, deduct them, which is a lesser known fact of the tax code that surprised a lot of people. I know it surprised me at first when I learned about that. And so, credits now. Moving into our last section of this lecture, but fair warning, it's probably going to be the longest, because credits are awesome, but credits can also be complicated, and there are many credits that we need to talk about. And so the first thing that I want to touch on is what exactly is a credit and how is it different than a deduction. And so a credit and deduction are very similar, and you will sometimes hear the words used interchangeably, but they really shouldn't, because a credit is applied after tax rates are applied to taxable income. And what this means is that instead of reducing tax due by a dollar amount multiplied by a rate like a deduction does, credits reduce tax due by just dollar amounts. And so this makes them much more valuable for the taxpayer than a deduction. And so credits are better than deductions because if you think about it, say that if we claim a $10 deduction and the taxpayer pays a 30% tax rate, they get a $3 deduction. If they claim a $10 credit, they get that $10 credit, and that reduces taxable income by $10 versus the deduction, which reduced taxable income by $3. So that's the important difference there and why credits are so much better than deductions in general. And so looking back to the chart here, you can think about where deductions and credits get applied and how they're different. So you see here, this is where the standard deduction or an itemized deduction, or even if we look at adjustments to gross income, those all get calculated in prior to the computation of taxable income before tax rates were actually applied to it to give us our tax liability. Whereas credits are applied at the very end, and they reduce this tax liability by a specific dollar amount in order to give the tax due or refund at the very end, which is why they are such a powerful tool for the taxpayer to be able to save some money on their tax return. So again, credits better than deductions for the taxpayer. And so the first major credit that we need to talk about is the credit for child and dependent care expenses. And so this credit is basically what it sounds like, and it allows the taxpayer to claim a credit for child and dependent care expenses for a qualified person paid to work or search for work. And so that last part there is the really important one, because this credit is specifically designed for individuals who need to have their children or dependents cared for while they are working or looking for work. And so a qualifying person for this credit is a qualifying child under the age of 13, or a spouse that is incapable of self-care, or a dependent who is incapable of self-care. And so if they paid child or dependent care expenses while they were going to work or searching for work, and their qualifying person meets any of those three criteria, then they will likely be able to claim a credit for child and dependent care expenses. And so the credit ranges from 20% to 50% of the taxpayer's expenses, and this amount is much higher than it used to be. It used to be, I believe, up to 35%, but don't quote me on that. This amount is up due to the current COVID-19 pandemic. Congress upped the maximum amount in the range, and so this is likely not going to be permanent. And so if you volunteer again in future years, there's a decent chance that this credit ranges up to a lower amount than the 50%. And publication 4012 includes the test for if the taxpayer is eligible to claim this credit. So again, whenever you're entering a credit or anything, make sure to look at your resources and ensure in fact that they are allowed to claim it. And the credit is calculated by multiplying the work-related expenses by a rate. And don't worry, you do not have to worry about that, because TaxSlayer will take care of that all for you. You don't actually have to apply the rate to the taxpayer's expenses. The important part for you is actually figuring out what the total amount of expenses are for this credit. And so here's some more information on how to calculate what the amount of the credit is. And so basically what this says is that eligible families can claim qualifying child and dependent care expenses up to $8,000 for one qualifying person, up from $3,000 in prior years, or $16,000 for two or more qualifying persons, up from $6,000 for 2021. This means that the maximum credit in 2021 of 50% for one qualifying person's expenses is $4,000 or $8,000 for two or more qualifying persons. And so basically this is talking about the maximum amount of expenses that can be put towards the credit in order to have the rate applied to it, in order to give you what the actual final amount of the credit will be. So that's an important thing to keep in mind, that this year that you can claim much higher amounts than you did previously. And if my memory serves me correct, this may be something that you want to know for the advanced exam. Wink, wink. I think that this may be an important topic. And so moving on here to a type of credit that is very important to us, as you can imagine, and that is education credits. And there are tax credits available to help taxpayers offset the cost of higher education, because we all know higher education can get very, very expensive very quickly. And so it's important here to refer to tab J in publication 4012, as that will have all of the information that you need regarding education credits beyond the basics I'm going to share here. And so there are primarily two different education credits. So the first one is the American Opportunity Credit, and the second one is the Lifetime Learning Credit. And an important distinction between the two of them here is that the American Opportunity Credit is 40% refundable, which means that 40% of the credit can reduce the tax liability below zero, meaning that it can be refunded back to the taxpayer. So that's why in general the American Opportunity Credit is viewed as more beneficial than the Lifetime Learning Credit. And so in order to claim an education benefit, you must verify that the following are true for the taxpayers. They cannot be claimed as a dependent on someone else's tax return. They are not married filing separately. Their adjusted gross income is below the limitations for their filing status and they were not non-resident aliens for any part of the tax year, or if they were, they elected to be treated as resident aliens. And so those are a few standards that they have to meet in order to claim an education credit. So again, it's important to just have that list, reference it, and check that whenever you are trying to claim an education credit for a taxpayer. And so the taxpayer must claim the student as a dependent in order for them to be able to claim an education credit if they are, for example, someone like a parent who is trying to claim an education credit for a student that they themselves are not. And so it is possible that parents can claim these credits, but they just have to do it only if the student is a dependent in order for them to be able to claim an education benefit. It's important to note that these education credits are reduced by untaxed benefits that the taxpayer does receive. And so you'll see how this kind of works in tandem when you're actually doing your returns with the calculation of scholarships and fellowships and how those factor into income. These really work hand in hand together, and they work together to give us the correct amount in the end. And so this is in publication 4012, and I'm not going to run through all of it, but this is a basic comparison of the two types of education credits. And you should refer back to this when you are filling out a tax return that is likely going to have education credits, as it will give you a lot of helpful information, as you can see. And so another credit that we need to talk about is the foreign tax credit. And so the foreign tax credit applies to those who have paid or accrued taxes to a foreign country on foreign sourced income and who are also subject to U.S. tax on that very same income. This is not something that we often see at our site, and it's something that we need to be very cognizant of because we are not doing the international certification this year. And so it's very important that you follow the steps in publication 4012 to enter the information correctly. And if foreign tax paid is reported on Form 1099-INT or Form 1099-DIV or Schedule K1, a specific form, which in this case is Form 1116, may not be required. And that's also important because we cannot fill out Form 1116 ourselves. And so if it's one of those specific forms there, or they provide us Form 116, we'll be able to enter the information. But if we have to fill it out ourselves, which it lists in publication 4012, some scenarios we have to, we cannot do that under our advanced certification. So again, if you see foreign taxes paid, that's an area where I would call a more experienced volunteer and make sure to refer to your resources, because that's an area where things can get very confusing and very risky for us quickly as far as making sure that things are always in scope. And so another credit here that we will see more commonly is the child tax credit and credit for other dependents. And so it's important to not get this mixed up with the child care and dependent care expenses. And so really what this one is that taxpayers can claim a credit for each qualifying child or qualifying relative that they have. And the child tax credit is fully refundable this year, which it has not been in prior years. So again, if you see a qualifying child, a qualifying relative on the return, they're going to be able to claim a credit. And so with regard to the child tax credit, families claiming the CTC will receive up to $3,000 for each qualifying child between the ages of 6 and 17 this year, and they will receive up to $3,600 for each qualifying child under the age of 6, and these numbers have been increased as well since the start of COVID. So if you volunteered with Value before, the numbers have changed and they've gone up, which, hey, that's good news. We like when credits go up. And in order to claim the child tax credit, the taxpayer must have at least one qualifying child. Well, that's pretty self-explanatory. And they must be claimed as a dependent. So that qualifying child has to be claimed as a dependent by the taxpayer. And so the child tax credit is pretty straightforward, and TaxLawyer will help you do the math on that one as well. And taxpayers who are not able to claim the full amount of the child tax credit may be eligible to claim the additional tax credit, which is refundable as well. And we don't see this one very much. So again, check publication 4012 for eligibility requirements, and they can claim up to $1,400 for each qualifying child, and it's going to be automatically calculated by TaxSlayer. So again, it's something you don't need to worry a ton about because TaxSlayer is going to do the work for you, which is always awesome. And the credit for other dependents. And so if they do not qualify for the child tax credit, there's a $500 credit for those dependents. So as you can see, it is a much smaller amount, but hey, it's still something. So we're starting to come down the home stretch here, and one of the credits that we still need to talk about is the Retirement Savings Contribution Credit. So the Retirement Savings Contribution Credit is a non-refundable credit that taxpayers may claim if they make qualified retirement contributions. And contributions to the account must be voluntary, and there are specific box codes on Form W-2 that you can look up in our resources for hints as to whether the contribution is voluntary or not. And I would refer to publication 4012 for specific instructions. And I would also ensure, again, as we talked about in the income section, that you are entering those box codes on Form W-2 into TaxSlayer correctly, because that will help you out in having this all be calculated correctly. So one of our final credits we're going to talk about is the premium tax credit. And so the premium tax credit is potentially applicable if a taxpayer purchased healthcare through the marketplace. So again, this is only applicable when a taxpayer purchases healthcare through the marketplace. If, for example, they just get it through their employer, they're not going to qualify for the premium tax credit. So basically what happens is when a taxpayer purchases insurance through the marketplace, an estimate is provided for the amount of premium tax credit that they may claim. And then the taxpayer is given the option to choose if they want some, all, or none of the credit paid in advance to the insurance company that they are getting insurance from through the marketplace. And we should check if the taxpayer has been provided Form 1095-A, because they have been. That's going to make our lives super easy. And again, the premium tax credit is not something that is super common for us, so my best advice is to follow publication 4012, because this is another one of those topics that we don't see very much at our site, but it can get complicated pretty quick, and so I would refer to publication 4012 to get more information on how to enter the premium tax credit, and specifically how to correctly enter Form 1095-A into TaxSlayer. And so one of the items that is important to understand conceptually, but TaxSlayer does a ton of work for us with, is the Earned Income Credit. So what the Earned Income Credit is it is a refundable tax credit for most people who work but do not earn high incomes. And for 2021 specifically, taxpayers can choose to use their 2019 income if it is higher than 2021's. And so that's going to be an area where we may have to manually override things a little bit more in TaxSlayer than we have in the past. And there are 3 general sets of rules for claiming the credit. There are rules for everyone, rules for taxpayers with a qualifying child, rules for taxpayers who do not have a qualifying child. And TaxSlayer will automatically compute this credit when you fill out a return. So this is again one that's important to be aware of. Understand what the purpose of it is, which is that it's a refundable tax credit for most people who work but do not earn high incomes. But it is not important that you know how to compute this credit, because TaxSlayer is going to do all of that work for you, and it's going to show up at the end of the return, and it's going to tell you it's calculating the earned income credit for you, and it's just important to understand conceptually what it is. And so the recovery rebate credit, this is going to be a topic that I'm guessing we get asked about a ton this year, and this has to do with the stimulus checks, specifically the 3rd round of stimulus checks that were received in 2021. So economic impact payments, aka stimulus checks, are really just prepayments of the recovery rebate credit. And the recovery rebate credit can be claimed on the return if they did not receive their economic impact payments or they did not receive the full amount that they believe they were entitled to. And generally, taxpayers were eligible for $1,400, $2,800 if they were married and filing jointly, and $1,400 additionally for each qualifying dependent. And so this is one where you should go through, and in Publication 4012, there are instructions for how much they should have gotten in the recovery rebate credits, total up how much they got for that stimulus payment, and how much they think they should have gotten, and make sure that those agree with what they actually got. And that will tell you if there is going to be a recovery rebate credit needed to be entered, because that is how they will be able to get that difference if there does exist one and they did not get all of the money that they were entitled to. And so that is the end of this portion of the lecture, and now I'm going to go ahead and walk you through TaxSlayer and the important tabs for this lecture. Okay, so I'm back in here in Publication 4012, and we're going to walk through real quickly some of the important tabs with regard to the topics that we have talked about so far in this lecture. And it's going to be important to note I'm going to run through these tabs quicker than I have even in the past, because there's just a lot of content that we covered. And as you can see here, we're going to be covering tabs E, F, G, H, I, and J here. There's a lot of stuff that we need to cover here in Publication 4012, and so I'm just going to have to move a little quicker than usual to make sure that all of it fits into this video in a reasonable amount of time. And so we're just going to start off here by looking at the adjustments to income, and when you open up this here, it's going to show you what the page is going to look like in TaxSlayer when you load it up and have to enter the adjustments to income. So this is a good place to come back to if you're not sure how to exactly enter those adjustments to income. As you see here, as we keep going down, these show you how you can enter specific types of adjustments within TaxSlayer, and it gives you instructions on how to actually do those. So here, this talks about educator expenses, which we talked about in the lecture there, and this gives you a lot of the helpful info that we already talked about currently, and that's on page E-4 for future reference. So here, self-employed health insurance deduction. This is something we talked about in the lecture as well, and something that you should be paying attention to. If there's a self-employed individual who paid for their own health insurance. So here, this is another one of those sort of interview scripts in a way that you can talk to the taxpayer with regard to their HSA accounts. And so that can be a very useful tool for you as well. So HSA accounts, E6, E7. Moving on to E8, where it talks about how you in fact can actually enter those into TaxSlayer. So now we're looking at here in this one, the Alimony Requirements, and this is the pre-2019 executed divorce agreements, which we talked about in the lecture already, because again, those are treated differently, and this is going to help you determine if you in fact can deduct them as an adjustment to income. Here, this time about the IRA deduction, which we've talked about, and how you can actually enter that. And now this section here is talking about the student loan interest deduction at a glance. And this is another area where I would refer back to it, and this is on page E11, because we're going to pretty commonly see student loan interest, and it's important to make sure that everything is being entered into TaxSlayer correctly. So E11, somewhere I would get used to coming back to. So as you can see, I'm going to be moving through these tabs pretty quickly because we've got a lot of content to cover. So we're going to move on to tab F here with deductions. And hey, there's that chart that was in the slide deck with regard to the standard deductions that gives you what the standard deduction amount is. So again, don't use this chart if they were born before January 2nd, 1957, or they are blind, or if someone can claim them as a dependent. So here's another important note, is that there are certain people who are not eligible to claim the standard deduction. So that's also something important to note. So here, this is the standard deduction worksheet for individuals who cannot take the traditional standard deduction. And so here, this is for itemized deductions and some interview tips if you have a taxpayer who is planning on itemizing deductions. An important thing here to note within this interview sheet here is that it's going to give you some items that are potentially out of scope, and it's going to alert you to those. And so that's an important thing to keep in mind here, is to pay attention if this little flowchart here, kind of where it leads you on the yes and no answers, leads you to something that's out of scope for us, such as this one here. And so here, this talks about now Schedule A, Itemized Deductions, and this shows you how to get to it in TaxSlayer and what it actually looks like when you open it up. And so this here is why I did not want to include this in my slides. Because as you can see here, the list of deductible and non-deductible medical expenses is very, very long. And so if someone has medical expenses and they're trying to itemize, come to F5 because this is a very all-encompassing list for both what you can include and what you can in fact include. So here, this is just giving you more instructions on how to enter medical deductions. Here now, this is talking about the taxes you paid, that itemized deduction that we talked about as well in the lecture. And this is just talking about, again, how to enter it into TaxSlayer. Here, more info on how to enter information on itemized deductions, such as the home mortgage loans, which we talked about already, and mortgage interest. So itemized deductions here, we have gifts to charity, which we talked about already. Really a lot of this section here with regard to the itemized deductions is really just entering stuff into the tax software. And so this section is really useful for figuring that out. And so here we get into the qualified business income deduction. And so this is one where I would refer back to it if there's an individual who owns a sole proprietorship. If you see someone owns a sole proprietorship, I would just kind of come to this as a general habit to make sure that that gets entered in correctly, because as you can see here, there are some intricacies to it, and so it's important that you enter it all correctly, and using this sheet here will help ensure that it's all done correctly. And so that's on page F12, publication 412. So moving on here to tab G, non-refundable credits. We're going to see here that, again, similar to all the other tabs we've looked at, this is going to start by just showing you what it's actually going to look like inside TaxSlayer when you, in fact, open it up. And so this is going to provide you more information on the refundable child tax credit this year, and this is an important thing to keep in mind. And then this here is the additional child tax credit, which, as we said, publication 412, it's got more info on it that you can reference. And so this here is helpful if you're not sure if a child or a dependent qualifies for the child tax credit or the credit for other dependents. So if you're not sure, you can just go ahead and check it out in here, or you can just go through this table as a precaution, make sure that you're always doing it correctly. And so this here is going to be important for this year because there were advanced child tax credit payments. I'm probably going to do a lecture later separate from the main series about some specific updates for this year that are different than prior years. But this is going to be one of them that you should keep in mind, because I also think that this page here might be useful for the advanced exam. And this is probably something that they're going to want to look at, because it was a change this year from previous years. So here, this is just talking about what the credit for other dependents is, which we've already talked about, and it gives you some other interview tips as well with regard to that. And the foreign tax credit here is the next one that it talks about, which again, we've talked about within our lecture. And this right here is again really showing you how to enter it. And again, it's important here that you really pay attention to what you are entering, because you can see there's a lot of ways that this can end up out of scope, and we do not want to prepare an out of scope return. And some of this tab is not applicable to us because it requires the foreign certification. So here, this chart and page right here refers to the child and dependent care credit expenses, and this is again something that's just important to reference when you're actually calculating that credit. And again here, this gives you some interview talking points that you can talk through the taxpayer with. I literally, for most of these credits, if it's a relatively important one like the credit for child and dependent care expenses, I just go ahead and read this. You can get done with it pretty quick. It's a real easy way to ensure that in fact everything is correct. So here, this is just showing you how to enter it all into TaxSlayer. So here now we get down to this, and this is the retirement savings contribution credit screening sheet, and this is something that we talked about in the lecture a bit, but that there are going to be some important notes here with regards to retirement savings and their contributions that you will need to pay attention to ensure that the contributions are in fact actually deductible. And so anytime you see retirement contributions and you think they may be eligible for the credit, come to this page, G15. That's going to give you the info that you need to know. As you can see, there are a lot of details that can go along with it. Here, showing you how to enter it into TaxSlayer. So here, now it's going to talk about the credit for the elderly or disabled. So this is also something that could be important as well for you. So there, showing you how to enter stuff into TaxSlayer. Okay, so we're coming down the home stretch here with tab H. And this is where they can report different types of taxes that they've paid throughout the year. And as you can see, much of this page here is out of scope. So again, be sure to proceed with caution. And so these are just some topics that are important to be aware of and know where you should go if they come up, but they are less common items. Typically what is shown within this tab. So here, the payments and estimates. This is not something that we see very often because in general, the individuals that we prepare taxes for are not sending estimates to the IRS and whatnot. We're going to see mostly withholdings on things like W-2s. So here now, the recovery rebate credit, and this is what we talked about at the very end of our lecture. This is where you go to enter the amount of recovery rebate credit that they actually have received. So you can just enter it, and pretty sure TaxSlayer will just generate for you whether or not they can in fact claim a recovery rebate credit on their return based on their life factors. And here we have credits for sick leave and family leave for certain self-employed individuals. Again, this is something that we don't see come up very much, so I didn't cover it within the lecture, but it's important to know that it's here if a self-employed individual had these circumstances come up right here. Again, this is just showing you how to fill it out. Yes, and now the premium tax credit section here. And so as you can see, when you're in TaxSlayer, it's going to ask you whether the TaxSlayer purchased health insurance through healthcare.gov or the state marketplace, and you're going to check either yes or no. and it will lead you to additional screens where you have to enter information there. And so this is the area really here that I was talking about where it's important to look at when they have Form 1095-A, because A, you cannot prepare the return for taxpayers who receive the benefit of a PTC for themselves or dependent without Forms 1095-A. But 1095-A is really going to tell you how you need to enter everything within TaxSlayer so that it can, in fact, calculate the correct amount of tax. So here it's going to provide you a bunch of instructions on what you actually need to enter for that. It's also going to give you a handy list of out-of-scope situations that we need to always be aware of. And here it gives you some special situations as well with regard to the premium tax credit that are important to keep in mind. As you can see, there's a lot of them. But in general, this is not something that comes up very often for us. And these are instructions related to healthcare.gov that we really do not deal with. For the most part, here is a listing of the federal poverty lines as well. There is included at the end of this section. And so, tab I now, this is all related to the earned income credit. And so this table right here gives you a breakdown of what income is included in the earned income credit and what income is eligible for it and what it does not include. And so also here it gives you a handy list of what some of the common errors are when actually filing the earned income credit. And so there are some specific earned income credit eligibility requirements, which it talks about here, but again, TaxSlayer will do this math for you. So here it's just talking about more general eligibility rules, the AIC with qualifying child, which we talked about in the lecture, that there are separate rules for individuals depending on their life circumstances, and the EIC here without a qualifying child. And here are the rules if there is a qualifying child of more than one person involved. But again, TaxSlayer is going to do a lot of that work for you. And so tab J here now, this is all related to education stuff. And so this, again, as we talked about in our last lecture, it talks about the tax treatment of scholarship and fellowship payments. That's something important to keep in mind. It tells you what education expenses are in relation to scholarship and fellowship payments. It gives you a nice worksheet there. And then here it gives you some tax benefits related to education benefits. So here is that chart that I pulled into the lecture of the different types of education credits that are available to taxpayers this year. And this is an important item that you can come back and reference. And so education credits now, this is going to give you more info on who can claim credits, what expenses qualify, and whatnot. And so here, this is going to give you instructions as well, determining qualified education expenses using tools like a 1098-T, which all students should have, provide them by their school. And this here just tells you how to enter the information into TaxSlayer. So there is more info on the American Opportunity Credit here. And yeah, that will wrap up our walkthrough of TaxSlayer and this video as a whole. Thank you for hanging in there. I know that was a very long video, but as you can see, there was a lot of content in this section by how much progress we made through publication 4012, and we are really coming down the home stretch here. And you should have most of the tools you need to be able to dig through publication 4012 and know the basics enough to prepare accurate returns for clients. So as always, let me know if you have any questions, and thanks for watching.